Stocks closed the week mixed as investors and traders watched while Washington lawmakers were at an impasse over another round of virus relief measures. However, the U.S. Senate passed a stopgap bill to avoid a government shutdown and to buy more time. And despite the uncertainty, the major stock market indices continued to trade just below their all-time highs. At the same time, it's strange that we've had an IPO market that parties like it's 1999 while coronavirus and jobless claims are spiking higher. Just call it IPO palooza or maybe ipopalooza. Sounds fun either way. But in these trying times, we have the courage of the media that has been advising everyone to look past the near term and focus on the longer term, where coronavirus is expected to be a thing of the past. Yeah, that's right. Don't look behind the curtain. There's nothing here to see. And with that, let's take a look at the charts. But first, this chart showing the put-call ratio. Normally when the ratio falls, that's a sign of complacency. But listening to the media, there's no complacency here, no bubble here. But remember, the last time we were in this neighborhood, the great financial crisis was just around the corner. But there's nothing to see here, so let's move on. And for a change of pace, we're going to look at the 20-year monthly chart on the 1Q, or the Fidelity Nasdaq Composite Index Tracking Stock, which is a relatively decent proxy for the Nasdaq, and it closed at 481.88 on Friday. Now, from this low in 2009, very nice move all the way up through here, with a minor exception of earlier this year. For the most part, that is a wonderful price chart. This is what you'd like to see in an indice, and unfortunately, it has a little bit of a problem. But let's go see that here in a second. First, looking at the volume, and this is not going to be able to tell you much, so we'll move past that. Here into the MAC. Look at how the separation of the fast line and the slow line, that's a large separation, so a lot can happen up here. And this, going back all the way 20 years, is the highest that either the fast line or the slow line have been. So it's nosebleed territory, and remember, pendulums swing two ways. Moving down here into the histogram, same thing. A very, very lofty histogram. Nothing in the 20 years is this high. Down here into the price rate of change, you start to see a little bit of the problem, and that is this top here. Now we're meeting that lofty level in this move there, but you'd want to see it move higher if there's going to be continual progress. So we're going to have to watch this one, particularly the down trend if it does move down, and then maybe the follow-up uptrend. Important to keep your eyes on that to see if things are rolling over. Moving down here into the RSI. Now, the Nasdaq has been one of the strongest indices, but just like the S&P, just like the Dow, we have a downward trend line in the RSI going back to 2018. We haven't been able to break up through that trend line, and that poses some strength problems, at least for me. This is the one oscillator that I keep pointing to that may reveal the undoing of each of these indices. Moving down here into the stochastics, not much to see here. Pretty much the same thing there in the Williams. Everything is very lofty. We're at a negative 0.96 on the Williams. That's very strong. But again, pendulums swing two ways. Moving back up here to the price chart. One last look here. The RSI oscillator is the main sticking point, at least for me. And so while you all have time, I would reposition or position your portfolios in the case that we do have some more downside coming soon. But as I said, the Dow, the S&P, and the Nasdaq are having problems with the RSI, but the Russell 2000 isn't. And that, to me, points to a change or a potential change in the economy and the indices. But we'll talk about that in a later video. And for today, that's ChewDog Charts. Thank you.